Let's dive right into this explainer and actually peek over the shoulders of billionaires. We're going to look at the top 10 dividend stocks that super investors just bought. I mean, honestly, it's one of my absolute favorite ways to uncover new investing ideas. We're digging straight into the actual data to see exactly what the wealthiest, most successful managers in the world are adding to their portfolios right this very minute. To make this super actionable, we've organized this explainer into 4 distinct playbooks. We'll cover tracking the smart money, the AI and tech titans, high yields and turnarounds, and the consistent compounders before wrapping it all up with the ultimate takeaway. Rather than just rattling off a list of stock tickers, we're really decoding exactly how the smart money thinks. All right, Section 1, Tracking the Smart Money. Let's get into it. Okay, so before we look at specific stocks, we kind of need to know who we're actually tracking, right? When we say super investors, we're talking about institutions and managers that handle serious capital. Basically, they're legally required to reveal their portfolio moves because they manage over $100 million in assets. Every single quarter, they have to file this paperwork, and it gives us this completely legal, wonderfully transparent window right into the minds of the market's biggest players. Now, what's truly fascinating here is the broader sector breakdown. The overall market has been absolutely roaring, and that's largely been carried by information technology, which was up a staggering 33%. And yeah, naturally, tech was heavily bought. But their most frequently bought sector overall, it was actually underperforming financials, which were down close to 6%. This is wild because it shows us that smart money doesn't just blindly chase momentum. They're actively hunting for contrarian value plays when a sector drops. Moving on to Section 2, the AI and tech titans. In our first playbook, we're looking at absolute titans like Broadcom, Meta, and Google. Now, you might look at them and fear their high price-to-earnings ratios, meaning, the stock looks incredibly expensive today compared to what they're currently earning. But wait, look at their projected earnings growth. Broadcom is projecting an astonishing 41.4% compound annual growth rate over the next few years. When a company's profits grow that incredibly fast, a stock that looks super pricey today actually becomes a massive bargain just a few years down the road. Nvidia is sitting at 27%, Meta is over 20%, and Google is cruising at a very healthy 14%. But there's a catch here. Companies like Meta and Microsoft are spending unprecedented billions of dollars right now. For the smart money, this brings up a really crucial question. Why on earth would you buy stocks with massive, soaring capital expenditures? I mean, usually, massive spending just eats away at your free cash flow, which is literally the thing that drives a stock's value. Well, the crucial point here is understanding a concept called growth CapEx. There is a huge difference between maintenance CapEx, which is basically just money spent to keep the lights on, and growth CapEx. Growth CapEx is money spent today that's intentionally designed to unlock and generate entirely new future revenue streams. For these tech titans, this is capital being heavily deployed to completely dominate the AI infrastructure tomorrow. And this creates an absolute paradigm shift. Think about the historical comparison for a second. For years, Meta and Microsoft ran incredibly capital-light businesses. They put roughly 15% of their revenue back into capital expenditures. But now, these historically capital-light businesses are pivoting, and they're pivoting hard. They're expecting to push nearly 50% of their revenue into capital expenditures to secure their AI future. It's a huge bet, and sure, the short-term free cash flow definitely takes a hit, but the super investors are clearly buying into this long-term vision. To see how that massive spending is already paying off right now, you just have to look at Meta. That spending directly fuels a 3-headed ad monster, where AI optimizes literally everything. First off, daily active people has hit 3.56 billion. Let that sink in. That is nearly half the global population interacting with their apps every single day. Second, thanks to AI optimization, ad impressions are up 19%. And third, because those ads are so incredibly effective, the average price per ad is actually up 12%. All 3 of the fundamental levers that drive their business are just moving up aggressively. Okay, let's jump into Section 3, high yields and turnarounds. So moving to our second playbook, finding hidden value. Let's take Comcast. Their stock has eroded over 50% from its highs. Their core residential, cable, and broadband business is facing some very real headwinds and declining revenues. So naturally, we have to ask, why on earth would smart money touch a stock that literally lost half its market value? Well, to understand this, we really must look past the surface-level panic and evaluate the shareholder yield. This is such a vital metric. Shareholder yield is simply the combination of a company's dividend yield and its stock buyback yield. Basically, it represents the total, tangible value a company is returning directly to you as an owner. And this combination is exactly why Comcast is a prime target right now. They offer a massive 11.27% shareholder yield. See, Comcast combines a high 5.3% dividend yield with massive stock buybacks. And because the stock has been beaten down so hard, they are trading at a dirt cheap forward PE multiple of just 7. What that means is management can buy back their own shares at a massive discount, which adds about a 6% buyback yield. Combine those two, and you get an incredible 11.27% total return. Even if their earnings growth stays completely flat, that yield alone is an incredible return on your money. Then we have United Health, which is navigating a massive turnaround. So from 2015 to 2023, UNH saw this beautiful 4x earnings growth. It was a machine. But then in 2024, they suffered the largest healthcare data breach in history. That led to a massive one-time earnings decline and, as you'd expect, intense legal scrutiny. But now, heading into 2025 with a leadership shift, it's a classic recovery play for investors who are willing to endure a little volatility. For United Health, the key turnaround metric that super investors are laser focused on is their medical care ratio. This is simply the percentage of premium revenue that's actually spent on medical costs, which is currently sitting at 83.9%. Keeping this number as low as possible is exactly what drives their profitability. It's incredibly important because even a tiny fraction of a percent improvement here translates to billions to the bottom line. If they can manage costs effectively and drive that ratio down, the historical compounding machine of this massive insurance giant turns right back on. Now, Disney shows us a very different kind of turnaround story. It reveals a really critical lesson. Even when theme parks and studios drive revenue per share up, eroding profit margins from a lack of creative innovation can still mercilessly punish the stock. I mean, Disney has struggled with endless sequels and remakes that have just failed to break through, and their gross profit margins have really suffered because of it. Super investors buying in here are betting heavily that new management can actually fix the underlying creativity issue, not just tweak the top-line numbers. All right, moving on to Section 4, the consistent compounders. Let's explore our third playbook. These are the businesses that don't need a turnaround. They just consistently print cash year after year. Take a look at this incredible number for Visa, 53.94. Thanks to deeply entrenched network effects, Visa generates an astonishing $54 of pure free cash flow for every $100 they make. I mean, it is an absolute cash-generating machine. They don't have to build expensive factories or massively increase capex to grow. Their margins actually expand over time, creating a foundation that acts as the ultimate natural hedge against inflation. Meanwhile, Sunbelt Rentals reminds us that even compounders face short-term macro headwinds. They recently shifted their primary listing to the NYSE, since most of their operating profit actually comes from North America. But right now, they're battling a slow 2.6% rental revenue growth, mainly because 2026 inflation is keeping the federal funds rate high, and high interest rates generally slow down massive construction projects. But here's the thing, super investors are perfectly willing to look past short-term rate environments if they are buying a fundamentally strong business. Finally, Section 5, the ultimate takeaway. Our final takeaway really comes down to this incredible quote outlining Jack Bogle's valuation model. He said, future returns are a result of 3 things: earnings growth, shareholder yield, and multiple expansion. It's like a 3-piece puzzle. Whether it's the massive AI capex driving Broadcom's earnings, the incredible 11% shareholder yield of a beaten-down Comcast, or betting on multiple expansion for a recovering Disney. Every single smart money decision relies on optimizing these 3 core drivers of value. So, having decoded these strategies, we arrive at the most important question for you. Which of these super investor playbooks are you going to use to level up your own portfolio? Are you chasing the high-growth AI titans, seeking out the hidden value in turnarounds, or building a rock-solid foundation of consistent compounders? Look, the data's out there, the plays are written, and now it's entirely up to you to execute. Thanks for learning with me today on this explainer, and stay curious.